Assalamualaikum warahmatullahi wabarakatuh and good afternoon to Puan Mazwina binti Hanim. Today, I want to present about International Finance Management. This is our team. First, Putra Muhammad Zakwan 1087 and Danny Hazri Hizat 1080 and Muhammad Farhan 1023 and me, Muhammad Hazim Lutfi 1033. For all overview, we have 5 parts. For 1, introduction, and 2, question, and 3, answer 1, and 4, answer 2, 5, conclusion. In today's globalized world, financial institutions play a critical role in economic stability and growth. However, they also face growing challenges in managing ethical risks associated with financial crime, including scams, money laundering, and bribery. Due to their influence and responsibility, banks and financial institutions are expected to uphold high ethical standards to maintain public trust. This presentation will explore 3 key ethical issues linked to financial risk and discuss strategy to mitigate the risk effectively. 4 questions. First, identify and explain 3 significant ethical issues and relate to financial risk in bank and financial institution. 2. Examine effective strategy for mitigating the risk associated with the issue in A. Ethical issue relate to financial risk. Scam such as phishing attacks, identify theft, and account takeovers present a constant threat to financial institutions. These fraudulent activities can result in substantial financial loss, erosion of customer trust, and regulatory penalties.
My name is Danny Hazri Hizat Muhammad Nazri. I take over for Hazim in question 1. Question 1 number 2 is bribery. Bribery is the offering or accepting of illegal inducement to influence decision. Can have far-reaching consequences for financial institutions. It can lead to reputational damage, loss of business opportunities, and legal penalties. To combat bribery, institutions must establish a strong ethical culture, implement strict anti-bribery and corruption policies, and conduct regular due diligence on business partners. Offering or accepting an illegal inducement to influence decisions create an uneven playing field, eroding trust and fostering corruption. This can lead to financial criminal activities and instability within the financial system. Regulatory penalties and loss of business relationship are likely outcomes if bribery goes unchecked. Question 1 number 3 is money laundering. The money laundering is the process of decreasing the origin of illegally obtained funds. Can have devastating consequences. Institutions may unwittingly become conduits for criminal activities, facing legal action and significant reputational damage. Additionally, laundering money can destabilize legitimate financial market. To prevent money laundering, institutions must implement robust customer due diligence (CDD) procedure, conduits ongoing monitoring of customer activities, and file suspicious activity report SARS to regulatory authorities.
Hi, I'm Farhan. So I will talk about question B. That's it. Strategy for mitigating financial risk. So first is avoid. To avoid risk associated with scam, bribery, and money laundering, company can implement preventive measures to keep these activities from occurring in the first place. Additionally, training program for employees can help them recognize scam like phishing email or fake invoice. If employees can identify and report this early, it reduces the risk of financing of the loss. For example, a global corporation might enforce strict vendor screening process before signing any contract. This may include verifying vendor credentials, financial stability, and any past involvement in illegal activity. By doing this, the company avoids partnership with vendors who may engage in bribery or fraud. So after that is transfer. When avoidance is not fully possible, companies can transfer some of the risk to the third parties, such as insurers or specialist compliance firm to help manage exports. Another way to transfer risk is by purchasing cyber insurance that cover potential financial loss from online scam. For example, if a company fell victim to a ransomware scam, the insurance would cover part or all of the financial loss, reducing the direct impact on the company.
Accepting risk is necessary when complete avoidance or transfer is impractical or too costly. Company establish an acceptable level of risk and manage within that threshold. This approach allows companies to balance the cost of risk management with potential losses, ensuring that they only invest heavily in areas where the risks exceed acceptable levels. Example, a small business might determine that low-level fraud, like minor billing errors, is within its acceptable risk thresholds because the cost of fully eliminating this risk is prohibitive. Instead of implementing extensive and costly control, they may monitor for irregularities and investigate only those that surpass a specific threshold, such as transaction over a certain amount. Limiting risk involves reducing either the likelihood or impact of scams, bribery, and money laundering through internal controls, transaction monitoring, and limitations on certain actions. Transactions limits are also an effective way to control risk. For instance, an organization might limit who can authorize transactions over a certain amount, requiring multiple approvals. This process reduces the chance of fraudulent transactions slipping through. Example, a bank may set a rule that large transactions over a specific amount must go through additional verification. This limits the chance of money laundering because suspicious transactions are flagged and reviewed by compliance officers before they can proceed. Conclusion. To conclude, the financial sector is under constant scrutiny for its role in preventing financial crime and upholding ethical standards. Addressing ethical issues such as conflict of interest, data privacy, and transparency is crucial for maintaining public trust and protecting clients. By implementing strong internal controls, providing employee training, and conducting regular audits, financial institutions can effectively mitigate the risk associated with these ethical challenges. Maintaining high ethical standards not only enhance the institution's reputation but also contributes to a more stable and trustworthy financial system.